All right, we are live. Hello and welcome everyone to the Trust Vista Talk webinar, the forum where we engage with senior asset managers and advisors across a broad range of topics. I'll do a quick introduction and then hand it over to the presenters. Trust Vista, briefly, we're the leading outsourcing firm for the financial services industry, support over 1,000 clients with over 10 trillion in AUM. Providing skilled support across due diligence, business development, portfolio management, data analytics, and other activities. To learn more about us, please feel free to visit our website and follow us on social media. We also have a Trust Vista Talk podcast where we have in-depth one-on-one conversations that you can access through our website or subscribe wherever you access podcasts. So without further ado, I'd like to thank our panelists for joining us today and introduce our moderator for the panel, Abilash Jaikumar. Take it away, Abi.
Thank you, Amir, and thank you everyone for joining us today. I apologize for being a few minutes late here due to some technical difficulties. I'm the co-founder and managing director of Trust Vista, and today we are going to be talking about not just the fundraising environment for private equity, given everything that's going on, but also take a chance to talk about LP relationships with GPs at a broader level. First, I'd like to introduce our panelists that we have with us today. Pradeep Ramamurthy. Pradeep is the co-head of investor relations at Open Gate Capital, a private equity firm that acquires and optimizes lower middle market businesses throughout North America and Europe. And there, Pradeep leads the capital raising and LP relationships for the firm. Prior to joining Open Gate, Mr. Ramamurthy advised clients globally on product development and capital strategy as the managing director of Kaveri, a San Francisco-based consulting firm. And prior to that, he was a managing director at the Abilash Group. And previous to his career at private equity, he served in senior operational and management positions at the White House, U.S. Agency for International Development, and the U.S. Intelligence Community. Next, we have with us Greg Jania. Greg is the global co-head of private equity at APG, a Dutch asset manager with 550 billion of AUM and approximately 40 billion in commitments to PE. APG makes annual commitments of $8 to $10 billion per year, euros per year globally. APG holds LPAC seats on more than 90 funds. And prior to joining APG, Greg was a partner at WP Global Partners and previously held positions in PE at G Capital and First Chicago Capital Corporations. Lastly, we have Warren Hibbert, who I think seems to have dropped out for the moment, was having some technical difficulties, but hopefully Warren will be able to rejoin us shortly. Warren is a co-founder and managing partner at Asante, a leading global independent advisory and private markets placement group. Warren manages a number of the firm's global fundraising and maintains relationships with investors throughout Europe, North America, and the Middle East and Asia. Over the past decade, Warren has led a number of significant PE fundraising, including mega cap global, pan, regional, and country-specific funds as well. And prior to co-founding Asante, Warren spent 7 years with MVision Private Equity Advisors, where he was a senior partner. Thank you, gentlemen, for joining us today. Maybe start off with, we can just start with a quick rundown of how the current environment has impacted, the fundraising environment. We have different perspectives from the GP, the LP, and the advisor, hopefully rejoining us shortly. So we'd love to hear what you've been experiencing the last several months and how things have changed. Maybe Greg, if you'd like to kick off.
Yeah, happy to, Abhi. It's interesting. It's been a big change even in just the last 3 or 4 months. In March and April, when COVID first hit, we had several GPs that we were going to committee on and looking at first closes. And there was a pause among many other LPs. Most of the GPs we closed on in March and April had closes far smaller than they originally expected a few weeks earlier. We saw a lot of LPs kind of go into, it wasn't a panic mode, but it was really more of, what's this going to do to my denominator effect? If I have a co-investor direct program, how is that going to be affected? For me making new commitments, people's boards and committees, they didn't want to rush into making more, fund commitments at a time when there's a lot of uncertainty in the marketplace. We use that to our advantage. We've closed 15 funds since March 1st, funds that we brought to committee, and got approval over almost 5 billion in commitments. We use that kind of timing to our advantage to actually get a little bit higher allocation in some GPs where we are going to be cut back kind of pre-COVID or below our target allocation. We had a little bit better terms, some GPs, able to negotiate a little bit, harder for a few points. It wasn't I wouldn't say it was a pendulum shift to LPs in any means, but it was definitely a little bit of an improvement for us in terms. But just in the past few weeks and closings since June started, we're seeing a kind of the LPs come back into the marketplace. Some large, fellow LPs who hadn't closed funds in March and April and even May, we're starting to kind of beg funds to get back into the final close in June, and we actually had a few requests for increases in hard caps in the month of June, which we did not expect to see when we were in the first close in March or April. So we have seen that the return of the public market performance has really pulled people back into the markets. People are a little less concerned with the denominator effect. Portfolios seem to be more under control. Boards seem more willing to commit capital. We're seeing, kind of the money really come back to the market in June, especially. I think we'll see that, at least for the next 2 quarters, unless we see a big shock to the public markets again.
And specifically, are there like challenges that you've faced that have persisted throughout this? Just apart from, it's clear that you guys have been more proactive than a lot of LPs and gotten ahead of this. But what are the challenges you faced, and if not you, what are the LPs that you're speaking with?
Well, I think one of the big challenges is, LPs have really branched into co-investing and direct investing much more in the last 4 or 5 years. So prior to in the last cycle that ended in 08 and 09 with the GFC, there was as many direct or co-investments in people's portfolios. I do think that had a much bigger effect in the first few months, of this crisis than it did last time, because people had this, overhang of, hey, I'm worried about my direct portfolio. It might be a third of my whole PE portfolio versus, 10 years ago is probably, 5% or 10 or non-existent. I think that concern, what are my liquidity needs with my direct portfolio, really paused, some traditional LPs from making investments for a while, just caused teams to slow down. The communication, if funds were closing in March or April, most people have done quite a bit of the work prior to COVID starting. So I don't think COVID had a big effect on those funds closing in March, April, as far as doing your diligence. So it's really more of an effect if your company or your firm wanted to commit more dry powder, given what was going on, where all the asset values were falling together, in March, obviously, for example. Once that turned around, people got a little more comfortable. We are seeing a challenge, though, in new managers, especially. We don't just do re-ups. Obviously, we want to have about 20% of our portfolio every year with new GPs. We do find that more challenging today. So people we haven't gotten to know very well pre-COVID, or who wanted to launch, or who, especially if they're in emerging markets, you're trying to meet with them more face-to-face to really sit down and see the body language with them, how they work with their teams, to meet their mid-office teams in person. That's a real challenge, obviously, right now. Europe is opening up a little bit. I've got colleagues in Europe that are actually driving to meet managers in Luxembourg, in smaller meetings that I didn't know would be possible a few weeks ago, but we are seeing a little bit of, opening up in Europe for that. Asia's a different story. We're still not traveling in Asia, so I do worry about making commitments to new managers in a short period of time, given that lack of face-to-face meetings and being able to be in the room with people.
And Pradeep, from the GP perspective, how have things evolved in the last several months, and what are some of the challenges that you've faced?
Yeah, so I think first of all, I joined OpenGate in the middle of COVID, although I had kind of started the conversation beforehand, which was, I think really interesting. And so, I'd say a couple of things. I mean, first of all, we're not in a fundraising mode. To me, that doesn't mean that we're not in an LP engagement mode. I mean, I'm a very strong believer that the LP GP dynamic should be kind of, from the GP side, I mean, it's kind of one of your main constituencies. I mean, I often compare asset management to something like Uber, where you have drivers and you have passengers, and we have an entire side of the business, obviously, that's focused on, kind of working with our portfolio, finding deals, investing with management teams, entrepreneurs, and those are effectively kind of the drivers, right, and kind of the asset management business, and the LPs are the passengers. And we're very focused, I think, as a firm, on making sure that experience of the LP feels like a full customer lifecycle experience. And so even when we're not in the market, we want to be opening new relationships, educating existing LPs, kind of using as much as we can whatever we're talking to our existing LPs about to talk to kind of future LPs. And I broadly agree with kind of Greg's comments in the sense that where relationships already don't exist, it's fairly hard to open them, although we're getting a decent number of inbound inquiries, and I think that's partly a reflection of our strategy, which is pretty operationally intensive. Some level of distress. I think we would say stressed rather than distress. turnaround, et cetera. And it'd be interesting to hear Greg's perspective on how the current environment has kind of shifted what strategies LPs might be focusing on. But I think where existing relationships exist, I actually think this is in some ways a better environment than pre-COVID, because I think people are finding themselves with a little bit more time, a whole lot more flexibility. People are open to saying yes a bit more, I think, because they don't have to travel, and we're seeing that, for example, vis-a-vis our kind of AGM that's coming up in September. The number of people that have been following us for the last several years that we've extended invitations to, I'd say 90% of those people are accepting those invitations. And I think that rate would be a whole lot lower if they had to kind of fly across the country or around the world to come, participate. So I think, you're going to see a kind of a bifurcation in at least two ways. One is, I think the folks that only talk to LPs when they're fundraising, I think that's a mistake in general, but I think that that's going to really be problematic, because I think what a lot of LPs want is to be part of this journey. I mean, to really understand, how did COVID impact your portfolio? What did you do? How is it changing? Not necessarily month by month, but quarter by quarter. How are you thinking about valuations, and how is that connected with kind of trading performance? How is that changing? So I think there's going to be an advantage to those kind of GPs that are talking to LPs continuously in a sophisticated way. I think the second advantage is going to be, as Greg pointed out, for GPs that were already on LP radars and are using this moment, maybe not to fundraise, but to deepen that relationship, to open the doors a little bit more, to share more, et cetera. And I think the third dynamic, and I think it is just going to be, around size. I mean, I think there is clearly, this has been a trend line for a while, but there's been a bifurcated kind of market in terms of larger GPs continue to take larger and larger dollars. I was interested to read yesterday that in the last financial crisis, we saw a huge amount of spin-outs appear as a result. It'd be interesting to see if that happens now and what that might mean. But I think from our perspective, we're trying to take advantage of the opportunity to be more sharing inclined, create new ways of engaging. Our AGM will obviously be virtual. We're investing in technology, not just in the portfolio side, but we've used the moment to really invest in technology upgrades into the management company. So digitizing a lot of things. I think those are going to be the types of things that differentiate GPs going forward. So that's what we're seeing. I mean, obviously conference attendance. It's interesting. I mean, I would say that the quality of the content of conferences is increasing. And participated in one recently where there was like a virtual layout and you could walk over to the bar or walk over to the hallway. I think some of this is just going to be a mindset shift in how people utilize that. And the last thing I'd say is I think GP receptiveness has ebbed and flowed over this period, right? I mean, I think in the early days, I think LPs were trying to get a handle on their portfolio, and trying to bother them then, I think, was emotionally unintelligent, right? I mean, they're trying to get a handle on their portfolio the same way we're trying to get a handle on our portfolio. I think there was a period after they did that, before Q1 valuations, where it was a good opportunity to engage. And then there's another cycle of kind of introspection, I think, by LPs on Q1 valuations. And then, again, an opening to kind of external views. So I think part of this is also calibrating this a bit to how, LPs are going through their own thinking on their portfolio and kind of finding the right times to engage and the right ways to engage.
But Pradeep, I like the mention of Uber, but as an LP and on many LPACs, I wouldn't want to be the guy in the back seat. So maybe the LP should be the co-pilot who doesn't have the controls. Yeah. I don't have a steering wheel, but I'm a co-pilot, because
no, that's fair.
I don't want to think of myself being a passenger just along for a ride with the amount of money we're investing in in the business. So
I just want more GPs to realize that half of their business effectively is kind of what they're doing with LPs, right?
We view it as more than half personally, because without money, there's definitely no money to invest. So
100%.
I know that companies are important, but we always, again, I think if you don't treat your customers, your LPs first, you're not going to get any portfolio companies to invest in. So
Yeah. And I think, the analogy I give is products and customers, right? The product is the investment. The customer is the LP. And every part of the equation matters, because if one part doesn't work, there is no other part.
Yeah, it's a two-sided marketplace. I mean, I think that's the critical piece of the analogy, I think.
Right. And you mentioned about early on in the crisis, we were worried about the portfolio. So the GPs who reached out early with detailed performance numbers, who was being affected, where liquidity was with their companies, where covenants were at. That's the GPs, we appreciated having that early read. Where they thought they were going to have issues in the portfolio, where they thought things were trending, what they were doing. Were they cutting costs at the GP because they were making their portfolio companies cut costs? We think that was a nice way to show symbiosis with their portfolio companies, if they were taking pay cuts alongside their CEOs, that they were making maybe take pay cuts in certain businesses. So I think the LPs appreciated hearing that, and now we're actually going through that, as you mentioned, round two, where it's funny because second quarter is going to be much worse earnings-wise for these companies, but valuations are going up, which is again a little too much weight probably being placed on public market valuations, because private market valuations are not public. But we're seeing valuations go up when the numbers are going down, which is going to be an interesting dichotomy when we come to the valuations from the GPs.
Are you seeing that? You should tell me.
Go ahead.
Yeah. So, are you seeing that universally, Greg? I think we spent a lot of time talking. Look, our position was we're not going to change the valuation methodology, period, during this time. And I think we took a pretty big haircut in Q1. Do you have in your portfolio, are you seeing GP, did you see GPs kind of think about spreading over 2 quarters, 1 quarter?
No. Yeah, I think the issue with valuations is, we're in over 90 something funds and 60 something GPs. Each methodology is slightly different, but what they mostly have in common is there's a lot of flexibility the GP has in setting the valuation. You're using comps, you're using public markets, DCF as well. So there is a lot of flexibility GPs have in the valuations. And what we're kind of seeing is, I think the GPs, no one expected the public markets to bounce back like they did. And so no one wants to be trailing the public markets this much. So they're kind of using the rebound in public markets to, increase the multiples in their portfolio, even though the earnings are going the other way, in a lot of companies. So yeah, we had about an 8% decrease in our portfolio valuations in Q1 overall, but very few that were up. Most were flat to down. But we're going to probably see flat to up increases at June 30th numbers, which again doesn't make a lot of sense when you think about where the numbers are going, but it does when you think about the GPs not wanting to have their PME look like it's 1,000 basis points behind the publics. So
to that point, Greg, not just even the GPs, but a lot of fund of funds or institutional LPs have are very siloed at their asset allocation. So even the individual at the LP or fund of funds is focused on private equity, doesn't necessarily want his portfolio to be lagging versus his public equity counterpart. Do you find, or even a question for you, Pradeep, as well, are LPs giving you input into direction of valuations?
Yeah,
I think we have Warren back. Hello, Warren. Can you hear us?
Yeah. Hey guys, can you hear me?
Hey, I can hear you. Well done.
Sorry, a little technical glitch.
No problem.
I'll give a very quick answer to that. We're not looking at it that way, and I think we're being pretty conservative. We have had conversations with LPs about whether they're seeing GPs change methodology. That was a very short conversation on our side. That it just feels like the wrong thing to be doing in the middle of this. So I think we're gonna try and maintain the same methodology. I think we've got a portfolio that crosses North America and Europe, so we are seeing slightly different dynamics in both, and we've seen that kind of from the start to now, right? Europe got hit earlier. They were a little bit more, I think, effective in containing it. They're coming out of it, more sustainably. North America was hit later. All of the businesses in our portfolio in North America were effectively deemed essential, so they didn't shut down. In Europe, they did, although in Europe they also got the benefit of some of the programs. I think we're gonna be consistent with our approach rather than trying to kind of look at what any LP or might want. I think my question that I've consistently been asking LPs is, I think it's one thing to kind of try and understand your current portfolio through this moment. You know those GPs, you've got a lot of confidence in them. I'm really intrigued in how are LPs going to look backwards at this time when they're making new allocations towards the end of the year or next year. How are you going to try and normalize this year, and what will you be looking for, right? Are you just going to do a lot more operational kind of metrics? I mean, that's I think our question.
Yeah, at one point, Abby, you brought up about what are LPs asking for. I haven't asked any of my GPs to influence their valuations, but I know there's LPs out there that do that because they're concerned, and they influence GPs on a lot of decisions they make, and valuation is one of them. DPI is another one. So again, I think that does happen. So it's it'd be naive of us to think that doesn't go on, that there's LP pressure to GPs to how they mark their portfolios. So I think it does go on. I do think I had committee this morning to approve a fund investment. It's a new fund for us, but not a new GP. It's a GP who has a new strategy that we're going to back. And the question came up, how are we getting comfortable with what this GP did in the prior fund? So it's fund 2 of a new strategy for APG, but not a new strategy for the GP. And they have 2 deals in their portfolio that look like they might be lost due to COVID. And so we had prepared the analysis saying, hey, look, these things might be written down. Here's what we think performance will look like. Now we know they couldn't have predicted COVID would take these companies, but we want to make sure we're comfortable managing going into that fund, even if those two deals do end up being zeros. We looked at luckily the performance has been good enough that we would still want to be in the fund with those 2 zeros. But I don't think we'll get people a total pass for COVID wrecking the business, but we'll have to look at it as an LP and look at what the GP did, what the original strategy was, how it was affected by COVID, what steps they took to manage around COVID, and did they do everything they could? Time will tell, but those are things that we're thinking about already.
Yeah, no, that's an interesting idea. This idea of GPs launching new strategies. Prior to this event, I was seeing a lot of private equity firms trying to launch private credit strategies and being opportunistic. They're trying to amortize their business development team. They're creating opportunities that might not be suited for equity, but suited for debt. And LPs would often be asking, are you the team that I want to do private credit? It's a very different strategy. Maybe Warren, from your perspective, what are you seeing in the market over the last few months? How have people been trying to introduce new strategy? How has that been received?
Yeah, we haven't seen a wholesale shift to distressed credits or anything in that sort of realm per se. A number of them have been around for quite a while. We've seen a lot of spin-offs from the large Apollos, Oak Trees, etc. in Europe and the States. But those have been funds that have launched probably in the last 5 or so years. We haven't seen this race for this obvious opportunity now to launch a new distressed platform because it's a very different world to what it was in the last crisis. Firstly, you've got the capital markets that are pretty stable. In fact, they're, unlike last time, they're going to be the element that saves this as opposed to needing to be saved. And so, and debt is pretty freely available. It's a lot less debt in the market than there was the last crisis, technically, but it's a very different one. And I think the points made on valuations, just to sort of go back on that, we saw across our 45 funds a very, very conservative brush over all those valuations in Q1 because it's very difficult to forecast. When you go into any crisis of this magnitude, to forecast what the rest of the year is going to do, which of your business is going to come out is very, very challenging. There have been those just to state the obvious point, in the technology, broadly speaking, in healthcare sectors that have done incredibly well. And when they're marking up because the performance is 200% above next year's budget. So you've got this huge bifurcation taking place. And, when people look back on this year, it's clearly a very strange one. I think it's impacted everyone personally massively. And so when it comes to how you just go about work, day-to-day work, looking after family, etc., it's taken a whole new realm, a whole new life. But we're going to have a very interesting second half of this year, I think, because you've got this bifurcation taking place. We're seeing premium pricing on the secondary side and at a deal side in those 2 sectors in particular, because there's still a wall of capital, both primary and secondary, looking for a home. And they're desperate to get deals done. It is sort of back on, certainly in Europe and in Asia. We're seeing on-site diligences being able to take place for transactions, that is. and people are trying to get deals done where there is an interesting opportunity, but at a premium to pre-COVID. And we're seeing the same as secondary slowly sort of comes back online, and you're able to price, which you haven't been in the past few months, where it's a must-have fund in typically one of those two sectors. You're finding that there's a wall of capital looking to invest. So we don't see this, to answer the question, we don't see this massive wall of sort of opportunist capital racing to the gates because it's now a distressed play, because it's not really distressed play. That's the weird thing. The businesses out there that are distressed are probably dead or dying, and others are. We've also seen a number of our GPs send clear signals, and these are, one in particular is the most conservative we know, send very clear signals that they're surprised at how the businesses are recovering. They're far from, safe and through the door, but it's far better than they expected at the end of Q1. So it's very difficult to tell because there isn't one rule for everything.
Yeah, obviously, if we're going to talk about fundraising between LPs and GPs, it's all driven by actual capital being deployed. And what happened, I think, kind of universally is deals kind of paused. So I think similar with allocations, Greg, you talked about the ones that were closed were ones that were kind of going on before the pandemic started and moved towards closure or pre-existing relationships. But in a GP doing a primary deal, these are very rarely existing relationships, right? So either the process was in motion and it's paused, or it got completed, but that pipeline doesn't seem to be being built up the same way. Maybe things are coming back slowly now, but maybe you can talk about what you're seeing from a pipeline development, and then maybe Warren and Greg can talk about what does that actually mean for allocations for the second half of this year and even demand for next year if capital hasn't been put to use.
Yeah, I think from a pipeline development perspective, I mean, I guess I have a view that everyone is a potential future LP, right? And so, one of the most difficult things for me to get used to when I made the transition from kind of my prior career in government to kind of private equity was getting comfortable hearing no. No one says no to the White House or FBI. People say no to GPs all the time. I think part of what we're trying to do is, first of all, I think we're looking years out, right? So I don't think anybody's making any kind of private equity allocation decisions certainly in a month's time period. And so, we're always talking to potential LPs. And I think what we calibrate is the pace of engagement, the substance of engagement, and kind of the depth, right? And so I feel like right now pipeline development is actually pretty robust. Again, going back to either GPs that or LPs that the firm has met over the last several years, LPs that I may know personally or other people at the firm may know personally. I think it continues to be a difficult time, I think, to just open completely unknown relationships, and that's for a few different reasons. People now, the same people that weren't replying to emails because that just wasn't their practice aren't replying to emails, but now you also don't have the ability to just pick up the phone and try and call them, right? That's not like a thing you can do unless you happen to have their cell phone, which I would encourage not to call unless you really do know them. So I think there's that dynamic, but from a pipeline development standpoint, I think this is the time when there's really an opportunity to deepen that relationship in a much quicker way, because also what COVID has done is I think it's really revealed what your strengths and weaknesses are as a GP. Like it's really revealed how you think about moments like this. And for us, having a strong operating team, I think it's a really good differentiator. So we're highlighting that. I think it's also a really important opportunity for GPs.
But from a pipeline of investment opportunities for you, investment team.
Oh yeah. That has also not really slowed down. I think we've got a dedicated business development function, that's integrated in the deal from sourcing all the way through exit, including looking for add-ons and things like that. We did pause that pipeline, as COVID kind of came into play, just to, and we kept those relationships warm. We also did use COVID to go back to kind of management teams and CEOs and the like that we've been talking to for the last 18, 24 months to see whether COVID was creating opportunities, particularly in larger firms where they might want to, look at disposing a non-core asset and things like that. I think, we've taken some opportunities to investment committee, and we're certainly diligencing more. I mean, Greg mentioned this. I mean, we can do that a bit on the ground in Europe. We can do some of that in certain parts of the U.S. And those are the main, in Canada, the other place that we invest. But I think that Warren is also right that deal activity will pick up in the second half. I think some of that is the financing markets coming back online. Some of that, I think, is also the current portfolio for a lot of GPs stabilizing. I think the second half of the year is going to look different than the first half of the year. But I think
Warren, Greg, sorry, Pradeep.
The last thing I'll say is I think Warren is also right that the valuation conversation here is different than I think what people would expect. I don't think people are moving suddenly into a significantly different valuation than they were pre-COVID. There's some compression, but it's not, I think, what you would expect.
And Warren and Greg, maybe if you can speak to how that pausing in the pipeline, is affecting the supply and demand for LP commitments this year, next year.
Yeah, so in terms of what we're seeing, it's been a very busy first half of 2020. And the numbers will reflect that broadly in the markets, largely because LPs knew where they were putting their capital at the end of last year. And those are the funds and there have been some large funds through Asia, Europe, and the States that have got done. There have been some first-time funds, in fact, as well. That's been more of a challenge. But in every one of those instances, the LP has spent, and the group of LPs, relevant group, have spent time with the GP. Perhaps not as much time as they'd like in the form of an on-site, but they've spent time initially. And so they're able to then complete their on-sites virtually, which they've done. In fact, we've had 5 instances now where an LP has committed to a manager having never met them, and 3 of those was a first-time manager. Now that's the exception to the rule, and we're not suggesting that that's anything that's going to continue to happen with a high frequency going forward. But there is this new normal, and it is evolving. But most of the WIP list, if you like, work in progress, has been completed now for 2020. And there are a number of state pension plans, for example, that just said at the end of Q1, we're done for 2020. Where many LPs, or most LPs, are very long the private markets because post the bull, they put a lot of money out. And so it's going to be deployed in this interesting time. It's likely to be a very strong vintage if history is to be believed. And so that's all good. Do you need to now really deploy aggressively in 2020 given the levels of uncertainty? Probably not. But the music plays on, and because it's one of those crises where the capital markets are still okay, a lot of the GPs are still fine, many licking their wounds, and there'll be businesses to fix and their businesses that won't make it through, but they'll come through this. You may well find that whilst it'll be, in our view, a relatively quiet second half of 2020, 2021 could prove to be a spike that sort of accelerates things back to a level playing field in terms of the quantums of capital committed relative to 18, 19, which were actually down years relative to 17. So it hasn't been a continual increase in capital raising over the last few years.
Yeah, that's good. Thanks, Warren. We'll be at our target for fund deployment this year. As you mentioned, most of the work was done and was kind of front loaded. We've committed to, including pre-COVID deals since COVID started. We've already made 18 of our planned 20 commitments for the year. We're willing to look at new managers, but I don't think a lot of new people want to rush in the market right now if they haven't had those, discussions yet. For one thing, their pipeline, it has slowed. We are seeing a rebound in deal activity, but it did slow for at least 2 or 3 months, which means, the time when you thought you would need money is 2 or 3 months at least delayed, if not a little longer. So people that might have launched in 4Q might be pushing that off to 1Q, 2021. For our co-investment team, for example, when COVID first hit, we had a deal. We actually literally approved a committee and funded, March 8th or 9th. Again, really early in COVID, we knew it was happening in Europe, but we think that deal was resilient anyway. A couple other deals in our co-investment pipeline went away because of COVID, but a few of those are actually coming back now. So the GP stay close. able to keep track of the portfolio company, the company over the last couple of months, and you can see that it's trending well, or where the rebound is. And those deals are back on our pipeline for co-investments. Not sure if we'll hit our target by the end of the year in co-investments. We're having a stricter, really watching the deals and making sure we understand the COVID exposure and what could happen with uncertainty in the markets with second and third waves globally. But I think we're going to do more co-investments this year as of today than I thought we would have as of March 15th. I think I've got 3 committee meetings this week for new co-investments that would be post-COVID deals. So again, all in healthcare and technology, not surprisingly, as we talked about earlier, but that deal flow is coming back to some extent. But still, again, we won't see the deal activity at 2020 match 19 levels, but we might very well be back in 2021.
Going to something Pradeep spoke about earlier about how, people going to speak to LPs only when they need money is a bad strategy, right? And, you should be having open lines of communication continuously with your LPs. And obviously this time period has created time and capacity for GPs actually to spend more time with their LPs. And, what both Warren and Greg were talking about now, being a lot of commitments being made already for the year. Maybe the second half of the year is going to be much more focused on conversations than actions. Maybe Pradeep and Warren, what advice would you have for GPs about how do you approach LP communications in a period where you're going to them without an ask?
I mean, I would have just simple advice, which is content-driven engagement, right? Yes, you should be, I think, talking to LPs fairly regularly, but you should have something to say, and that's not just a repeat of kind of what you said last time. So that would be my main perspective. Is I think this time period is actually producing more content than usual. Just in terms of what we're seeing in different markets and different sectors, the steps we're taking in different portfolio companies, steps we're taking at the GP level. So that would be my main bit of advice. And I think, the way I think of that is that your opportunity in between fundraisers is to enable LPs to really do diligence on the firm, so that by the time you're actually in market, they're doing diligence on the product or the fund or the strategy, and that's where the diligence is focused. So I really think of this time period as an opportunity to put people through what I personally call let's call it GP 101. So what are the most important things that you think differentiate you as a GP, and kind of systematically walk people through those kind of building blocks so that on the other side of this, they understand who you are, why you do what you do, and why you do it better than others, hopefully. But yeah, content would be my single recommendation.
So I'd say it depends on where you sit on the spectrum. If you're one of those working at a large established firm coming to market towards the end of this year, you're probably fine on the basis that you're an established firm with a strong track record, good, relatively stable team, and you'd have a good sense for the demand now because the market is just so bifurcated. So that end of the spectrum will always be fine and will continue to be fine to a greater extent. As Pradeep mentioned earlier, I think the bifurcation is actually going to get more intense following this crisis. If you're at the other end of the spectrum and you're a new manager, that's where it becomes a challenge. Because right now, unless you're a spin-out, but a perfect spin-out, and there are a few of those, where the LPs know you as an individual from your prior firm and the team can get a good sense for the relative attribution, it's still a challenge because it's a new firm. There's sort of going concern risk and all the rest of it, in addition to fundraising risk. And so what do? You've made the decision to launch. Timing wasn't so great. You're now going through COVID. And you need to raise money. And the advice there would be, don't stick absolutely to the simple path of going out and raising a fund necessarily, because the back half of this year is going to be tough. And so you're probably looking at a raise at the beginning of next year. And if you're having to create new LP relationships, that is just a huge struggle. You can do a lot virtually, but unless the LP is looking into the whites of your eyes and has spent a little bit of time with you, at least a fair bit of time in the past, know you from your prior firm and the rest of the team all from the same firm, it's probably the best advice I can give is go out and try to get deals done. which is not, it's easier said than done, obviously, but build a track record, a deal by deal track record, one or two, but make sure you're continuing to do stuff rather than just sort of hang five, close your eyes and say, we're just going to raise this the way everyone else raises, because you'll be in the market for years without a penny. So it's a challenge, in the middle of that spectrum. If you've got a challenged track record, it's sort of put your head down and don't come back to market to the best extent possible, i.e. draw out as much time as you can to fix the portfolio. And that's pretty much for everyone. I think anyone trying to race to the market right now needs their head read, unless they're in a position where they know the demand.
Yeah, no, that's a good point. I think when we've had GP conversations along the same route as Warren mentioned, when it's newer managers, we're doing some work, and because we never know how fast this is going to end or open back up. But again, the biggest risk we usually have is with a new manager. We've had two issues in the last 9 months where these were fund twos being raised. So there have been new GPs to me, but people we've been monitoring since they're fund one. But during our diligence, we found huge operational issues, fraud in both cases where we did not invest. And you just don't do that without really digging in and knowing somebody, meeting their operations team and kind of asking the right questions and talking to their vendors. I mean, that's how you uncover it. And, so it's really hard to do that if you got to do everything virtually.
Yeah. So, to that point, just on due diligence, going through this experience of working remotely and from at home, have you developed new approaches to how you conduct diligence so that you can maybe get further ahead before you have to look at the whites of their eyes and maybe be that a final just check?
Yeah, there's some, other new platforms out there. So we've got a data request that we put out for GPs, but we're trying to make it more homogeneous. So across, GPs can just do the same one. We try to make it so that it's similar for all GPs. They fill out one data request, we get it, but all GPs have their own way of filling out data and sending it to the LPs. But there's some providers out there now who actually will go to the GPs themselves and be kind of just the intermediary and hold the data. The GP then uploads it kind of continuously, and as an LP, I can go in and look at the data if the GP approves. So I can do some work ahead of time when the GP is not necessarily fundraising or have their data requests kind of up and running. So it's a good way for me to stay on top of how people's performances, how their value creation plans are working, even when they're not fundraising. Because most of the time, the GPs only want to provide the data to me when they're actually opening the data room and they go fundraising. But I've got to give them a lot more work done before that. So I think there's new software platforms out there, new provider platforms where they can continually put this information out there. The GP can review it, and they can choose what LPs can see that. I think those platforms actually help us stay, up to speed with the GPs better during this COVID. So
yeah, we've seen a lot of clients leveraging us for that service part of that. I think a lot of the GPs that don't share as much information with the LPs as the LPs would like is not because they don't want to, it's just a capacity issue.
Exactly.
So they fall into this trap of I will update the data room every 3, 4, 5 years, right, versus it should just continuously be updated, not just for the LPs you have, but for these points, the LPs you want. And as you mentioned, you follow a GP maybe for 1 or 2 funds before you're ready to make that commitment. And unless there's something to follow, then that first meeting is a waste of time.
I think just on that point, and I think Pradeep made a similar one earlier, is the level of transparency is crucial. And we've just seen so many GPs over the last few decades adopt 2 different approaches or stances. One is, look, just take the data within reason, just take everything. You want to understand all of our policies, all the rest of it, everything sort of in every file we've got. It's a complete open book. And yes, there's proprietary data in there, but that's the level of trust. That's the way the industry works. It's self-regulating in that regard. And there are others that hold everything really, really close. So you've really got to pry their hands back to get pieces of data, and that's going to be a huge challenge right now if that latter approach is adopted.
And speaking about transparency, one thing that'd be interesting to talk about is just fund financing as that world has evolved. We had a podcast, 2 months ago, or early in this pandemic, where senior executive in the fund financing side was talking about how portfolio companies were borrowing with a guarantee against the subscription line. So the borrowing was happening at the portfolio company level, but it was happening rapidly because they could get a guarantee from the subscription line. Things like that don't necessarily require direct LP approval, but I imagine those are the type of things the LP would want to know about. How have GPs dealt with fund financing and communicating with LPs what's going on?
Well, I think during the negotiation period, usually how the credit line will be used is spelled out in more and more detail as we get more transparency. And ILPA just released new transparency guidelines for credit lines. And one of the items is making sure you're telling people what it can be used for, and so that the borrowing base, we know how much could be on a line, whether it's a line or a guarantee, and make sure that's inside the borrowing base. I think again, guarantees have been around forever. Funds have guaranteed debt for companies since I've been doing this, but having the credit line there already makes it faster to get a deal done, and the GP doesn't need to go through any information sharing with the lender to get that done because the credit line is already there. But again, we want these done within reason. I mean, I think we wouldn't want it to be usually it's around 10-20% of the line, the borrowing max. So it shouldn't be used for every credit. It should be used for things like on a bridge basis for the most part, and it should be transparent. You said transparency is key. What I worry more about in fund finance today is there are funds out there that are struggling in their portfolios, and what they're doing is they're going to fund finance providers to look to borrow against their portfolio without really being in communication with the LPs about it. So it's a new borrowing they want to put on outside of the credit line. And whether they go to somebody, whether it's a preferred piece of paper against the fund or a piece of straight debt against the fund, I'm hearing about GPs talking to fund finance providers about this, and I'm cautioning the lenders out there, fund finance people, is if they're not telling their LPs they're doing this, is that someone you want to be in business with? If they're not going to be transparent with their LPs on fund finance borrowing, do you really want to be the lender to someone who's not transparent? Because I am hearing more stories about GPs doing this without talking to their LPs about it. I think that's a huge mistake.
And one of the things we talked just a moment ago was about the tools being used to achieve transparency. Pradeep, what are some of the tools that you're utilizing, and how are they being used to achieve the LP's growing need for additional transparency and reporting?
Yeah, so I think every GP says they're unusual in this, or they've got a unique proprietary capability, right? But I think having been at a few others, I mean, we are very technology oriented. We only really invest in technology and industrials, and so I think we've also ported that over kind of internally. So we were developing this before COVID, but COVID has really accelerated something that is basically an internal technology platform. So all of our portfolio companies are feeding a data lake using their CRMs, their ERPs, their various technology platforms. And what we're doing on the other side of that data lake is layering in a fleet of analytics layers. Some of those analytic layers are being used to go back to the portfolio company management companies and enable them to kind of array data in ways that help them make better decisions, whether that's kind of utilization of factory equipment or their sales force, et cetera. And some of that data is being used by us to feed back up to the LPs, kind of views on how our portfolio companies are doing. Now, some of this is just being more efficient for ourselves. Some of this is improved transparency for the LP. So for example, we've been providing kind of monthly, I'd say every 4 to 6 weeks, we've been providing reporting on the portfolio to our LPs, and we're providing kind of operating metric data, revenue, EBITDA, order intake, liquidity, and some of this has been triangulation a bit around how much is too much data for our LPs. I mean, at some level they're trusting us to run the portfolio, right? And how much is too little. And so I think we're trying to automate that as much as possible. So like today, I can log into a portal and see kind of a lot of these operating KPIs for our portfolio companies, in some cases on a daily basis, in all cases on a monthly or basis. So we're really using this time to kind of, I think, dramatically upgrade the digitization of all of that information, and we're going to be talking about that at our annual meeting to some degree. But I think it's not just kind of transparency. I mean, it speaks to what you and Warren were talking about. A lot of the reasons GPs don't provide this data to LPs is because they can't. I mean, they just don't have it, or they don't have it in a way that is click of a button, and instead it triggers a massive manual process, right, to provide that data or update the relevant deck or the material, whatever. And so I think we're really trying to digitize that. And yeah, I mean, some of our LPs ask one level deeper questions, others don't. And to talk about transparency in the non-LP, future LP world, we're also sharing some of that data with future LPs, as Greg said, because we want them to understand how we make decisions and what's going on, as part of the process now, rather than just when we're going to eventually maybe ask for money. So that's what we're doing. It'd be good to hear what others are doing too, actually.
Yeah, we focus on the, given our size, we're focused on larger companies. So I mean, we don't do very many funds under $1 billion, nothing under 500 million. So our average EV deal is probably our minimum EV of a deal we're in is probably at least 100 million enterprise value, if not closer to 2 and then up. And when I meet with new GPs, if they don't tell me they could actually on their phone or their iPad or laptop see the KPIs at least from the last week on their portfolio, they're way behind the times. And I don't know, if they can't keep track of their portfolio and they don't have ability to do it when they're traveling, I'm really worried that are they really on top? Are they really advanced enough to be managing my money anymore? Because again, I feel that they're stuck in the past. They're not that far advanced digitally, or if they're not at least moving there. I mean, these companies are all big enough. The data is so important. You need to have it yesterday. And if the GPs don't have it, that makes me nervous. If they can't, show me on their laptop or iPad that, hey, yeah, here's the KPIs from as of Monday for my portfolio. We expect to see that in most of the funds we deal with, given our size.
Yeah, we have an entire department called our data intelligence group, which basically works with portfolio companies to create those data lakes and create those customized dashboards. But there's a lot of software tools out there that will report these things, but the challenge often is software still requires labor. So who's inputting the data?
Yeah.
And is that data being input correctly on a timely basis and consistently from a methodology perspective across portfolio companies? And this data has the 3 stakeholders. It's the management company of the portfolio company wants it,
right,
the GP wants it, and the LP wants it. So, and if each one has a different system, then transferring data becomes often a challenge as well. So, one of the things we find ourselves doing is just writing code to pipe data from here to there and from there to over there. But certainly evolving how information is captured, which is evolving how decisions are being made. Warren, maybe, we just have time for a couple more questions. As this crisis has evolved, how has the balance of power in negotiating fund terms, shifted between the LP and GP? I think we might have lost Warren for a second. We can hear you, Warren. Go ahead.
Am I still there?
Yeah, we can hear you.
It hasn't changed massively. So we're negotiating a bunch of closes right now. There's no huge COVID change in terms of the balance of power. Again, it's down to this level of bifurcation within the market. There are those GPs that are able to be slightly stronger in terms of sticking to the terms that they're looking to get. But for the most part, I'd say that the market has moved to one that is largely an LP-friendly one. The most important thing is to get in and raise the capital efficiently so that they can go out and deploy it. And so they're not looking to win any sort of major battles. I think both sides, the LPs and GPs, have come to a sort of central line. We've sort of seen in most instances, there's always some debate around the margin, but it's really on the margin now. Most of the big stuff, the LP protection clauses, etc., are just seen as the norm, and so we're not seeing much pushback. But there's certainly no influence of COVID that we've seen in terms of a shift in the balance of power. It's LP friendly for the most part, and in some respects where it's a fund that's a couple of times oversubscribed, they effectively get to call all the terms, and I don't see that changing.
Yeah, I would agree. I think that the slight difference I would say is there, in the beginning of COVID, especially if there's a fund have a larger fund at the beginning of COVID, they're going from 6 billion to 8.5 or 9. COVID had just started. I think those GPs, I was able to get them to commit a higher GP commitment to the fund, given they wanted to raise more. I think that helped, during COVID. But again, I think that's less so today than it was 3 months ago. And again, earlier on, we had a little bit better chance of getting our allocation. A lot of times at our size, we get cut back. I might want 500, 600, 700 million and get cut back to 2, 3, or 4. I had less of those problems 3 months ago than I'm going to have, I think, going forward, unless we see another, downturn.
And we have a question from the audience here, and I encourage the audience to please submit your questions via the chat. So going back to the conversations we had about valuations earlier, and different folks having different methodologies and approaches to it. As an LP, to what extent do you trust the GP generated valuations? How much weight are you putting on those, and how much are you recreating, if at all?
Well, we don't recreate, but we go through every fund every quarter and go through if they change methodology at all. We go through the multiples they're using. We go through what the leverage is at, on based on an LTM basis. And we are trying to figure out if we have anything that we've vehemently will disagree with, and we have a process internally that we could challenge those valuations and write the company up or down internally, different than a GP mark. So we do that every quarter. We don't have a lot of those changes. I think the main protection we have is that GPs in private equity aren't taking any carry on unrealized valuations for the most part. So we have some protection there, and we have a clawback in case something happens in the future. So we do monitor to make sure that our GPs are not too much off market. But again, if anything, they've generally been more conservative. Usually, this might be one of the few times, given where the markets are going, that they might be a little on the aggressive side. But generally, GPs are more conservative because they don't want to see a deal sold for less than they marked it at the prior quarter. So, but in this day and age, or this time when we have the public markets racing ahead, I think there is a little bit of that. Let's use the new public comps, weight that more heavily, or weight DCF more heavily in our valuation methodology today than would have been the case a quarter or 6 months ago.
Yeah, I'd say that what's interesting is broadly amongst the LP community, I think there's a reticence to mark down again after marking up. We've seen a few mark up in Q2. Most have marked down marginally. But what you don't want to be in is a position where you've been too aggressive on your marks in either way, but certainly to the positive, and then have to mark down in a sort of Q3, Q4 scenario. So everyone's trying. I think most were very conservative in Q1 because you just didn't know what the rest of the year was going to bring. And I think they've sort of seen that a number of their businesses are likely to come through this okay. They may have lost a year's growth. Some in those two sectors we spoke about have come through even stronger. And slowly, I suspect you're going to start to see markups through Q3, Q4 as they get a little bit more confidence in their underlying companies. The counter to that is, I think a lot of the world is waiting to see when there's potentially another correction, because the public markets seem to be slightly out of whack with broadly where the operating activities of those respective businesses are. So I think there's a lot of uncertainty still to come this year, but GPs, I believe, will remain pretty conservative until we're through this into 21.
Yeah. And obviously, most folks aren't participating in carry and unrealized valuations, so there's a value to the valuations, but not in the same way as it would be in a public context. But what is this doing to the idea of exits, right, and the timeline of exiting portfolio companies? There's a lot of work and conversations around, righting the ship, what needs to be done, to help address the current situation. But what does that mean to ultimately the exits?
There's only so much capacity to handle exits, so we are seeing them start to come back. We got 3 deals we're looking to buy into, co-investments that would be new deals bought from other sponsors. So we are seeing deal flow kind of come back in the markets. But we did lose 2 or 3 months of activity, and even if things are back to normal tomorrow, there's not like all the extra investment banking work and everything can just be done to get the levels back where they would have been for 2020. So it's going to be a lighter year. We're doing much more work. Buyers are doing much more work around what happened during COVID. What's the NAVBAC, much more closely looking at the adjustments and everything else. So I think it's going to slow down a little bit. We will have less distributions this year than people expected going into 2020. It won't be as high as we expected, but it's not going to fall off a cliff either. And we'll hopefully by 2021, if there's not a severe second kind of wave or something or shutdown, we should be back, closer to normal on the distributions.
Yeah, I think I'd echo exactly that. I mean, there were several exits that we were working on prior to COVID that were paused, that have come back, and I think that's part of what you'll see in the second half of the year is that type of deal activity pick back up. I think at the end of the day, you've got a lot of dry powder sitting in the private equity universe. That's got to get deployed to a certain degree. I also think, I'm not sure how much this is driving decision making, and it's certainly not driving our decision making. But the tax universe could look very different next year, depending on what happens here. And so, I think there are a lot of different drivers that will lead to a more significant amount of activity in Q3 and 4 than I think people would have expected in Q1 and a half, if I could put it that way.
So the next question is maybe more geared for Pradeep and Warren. Coincidentally, we're having a webinar next week on the impact of 401ks participating in private equity. So the question from the audience is, what is your view on technology platforms that are helping raise capital from larger groups of HNIs or small family offices, whether it's, new age wealth managers or technology platforms? How is this, if at all, affecting how you think about fundraising? Warren.
Go ahead, Warren.
Maybe I'll kick it off. I think it's a very interesting development. There are a few, iCapital is probably one of the bigger ones, but they're still relatively small in the bigger scheme of things. So as part of the greater LP universe, it doesn't really move the needle significantly at this stage. When, and I do believe it's just a question of when and hopefully not too much time, when the retail market can start to participate in private equity, I think it becomes very, very interesting. And that's when those sort of portals, as well as other investment banking and private banking type initiatives will start to really flex and become a lot more significant. That said, there's interesting dynamics at play right now. You've seen reports of family offices and high net worth individuals pulling back. At the end of the day, whenever there's a crisis, it's typically that part of the LP community that forget that it is illiquid. And so it's going to be interesting to see how it adjusts, but I haven't seen, there's no sort of significant impact or adjustment through COVID of that part of the market at this stage at all.
Yeah, I guess my perspective on that is, look, I think there's a lot of capital in private wealth that will make its way to private equity over time. I think this will play out not unlike what happened in the large private wealth platforms, whether that's Merrill, Morgan, JPM, et cetera, where I think initially the primary beneficiaries of that are going to be the very large brand, what I would call the private equity brands, right? Because I think initially there will be a flight to size as a kind of de-risking tool, and then eventually maybe it'll flow to other strategies and other managers. That'll take time. It's just starting to happen, I would argue, in the private wealth space. So for that on the platforms, I think it'll take years before you're going to see most private equity firms benefit from that versus a very concentrated few large ones. The second thing I'd say is, as someone that kind of ran a team that did take advantage of the private wealth kind of space, it requires a lot of people. You have to have a team that is really capable of going out, blocking and tackling on the ground. Even the private wealth platforms, it's easy enough for them to put a private equity fund on the platform. It's up to the GP to really persuade users of the platform, whether that's a private banking client or an iCapital user, to invest. And that is much harder to do. And I think there's a lot of lurking that I think happens on these platforms. So it's interesting to see, but it's a different ballgame when I think it comes to deploying capital. And I think only very large platforms, private equity firms, can really do that right now. And I think the last thing I would say about that is, you're seeing, by the way, the development of these platforms not just in North America, but also over in Asia, and that I think will be really interesting. But I think it's going to be years before these become really a significant part of the overall private equity LP landscape. Not that it won't happen. It's just going to take a lot of time.
Yeah, it's interesting. I mean, we have 5 million beneficiaries, that we support through their pensions, in private equity. And your private equity, we're only 5% of the portfolio, but we probably get 95% of the questions from the beneficiaries on private equity. So I do worry that there's a false sense of hope of people thinking that this is going to be a godsend for growing the asset class. It might, but I mean, they carry with them a lot of baggage. And when you look at all the different layers that are going to be taken out when you get to this level of person that's going to be investing potentially out of a 401k, and the illiquidity of the asset class that they're just not going to be used to, it may not be it's not a holy grail. It's not the nirvana I think the private investors are going to think it is. I mean, the most astute, or people who think they're most astute investors in 401ks are the ones trading themselves. And you can't do that with private equity. So I don't know who's going to be willing to go into an asset class who pay 10 times more fees than anywhere else for unproven returns, and you have no liquidity. I just don't know if it's the holy grail people think it is.
Speaking about, taking the layers out and what the net returns are going to be, a question from the audience is, have the benchmark returns for PE changed given the current global outlook?
Well, we've always had a relative benchmark and an absolute. And again, given our size, we're looking for, low to mid-teen net returns, and then performance that'll outperform the public markets, consistently. We're not looking for 20%. If we can't, at our size, it'd be impossible to get 20% net IRR. So I think each investor's got their own risk tolerance and based on the size of their portfolio, what they want. But ours hasn't changed in 7 years since I've been at APG. We've luckily been able to outperform that because it's been a very good environment. But even with a couple, years like 19 and 20, I think we'll still be, outperforming our benchmarks.
Yeah, I think it is a relative game, and always will be a relative game, as Greg says. But I also don't think that there's a sort of massive COVID impact where people are now expecting lesser returns because it's going to be more difficult to make money. It's just you're going to go back to sector by sector, business by business. There's a lot of opportunity out there. When does growth come back? Again, it depends on what sector and what geography you're in. But there are opportunities out there, and I think that both relative and absolute actually holds. And so just very broadly and oversimply putting it, a private equity practitioner investing in businesses from a buyout perspective or growth perspective is typically looking to make somewhere around the sort of 2x net. That's a good return, and that's what we should be aiming for. Not everyone hits it, doesn't mean they're a bad manager, but there is a sort of absolute element of that. And more so these days, it's sort of skewed towards IRRs, and it's got to be sort of late teens net, early 20s, you're in good territory.
Yeah, we'd love to be 2x net if all our funds are 2x net, but I mean, we're more likely in the 1.7, 1.8 net returns. But again, we do think that we try to look at the probability of a fund returning 2x net, because that's, again, like Warren said, we don't eat IRR. So multiple is very important to us. That's why we're not really fans of the credit lines and fund finance and everything else. But we do still look for people who've generated 2x net in their track records. We don't, again, we're not going to be perfect, so we won't get that in our portfolio, but we are looking for those managers who've done that.
Well, maybe last question, gentlemen. In your view, what are the few material changes that will stick around for a longer term once the dust settles? Pradeep, if you want to take that first, 1 minute each.
Yeah, I mean, so my personal view is that we've crossed the Rubicon in terms of people wanting to work from home for a significant part of the week. And, this is a conversation we have internally all the time. People have different working styles. I mean, I think we're in the business of competing for that top 0.5% of talent. And that talent decided somewhere in May that they're not coming to work on Friday afternoon. We've got to figure out how to enable that, I think. And I think the more sophisticated conversation is around not do we work from home, do we not, but what is it that what are the parts of our business that are suffering because of working from home? And if I had to pick, I don't think it's productivity. I think it's culture. And I think it's things like onboarding and a new talent. And so that's where we're spending a lot of time. I think is thinking through how do we retain that corporate culture dynamic, in a work from home extended scenario. Keep in mind, our Europe office is already open. We've gone through openings in LA as well. And so that's going to be the question. I think it's not about productivity per se. It's going to be about culture, and particularly about how do you create kind of those informal encounters that not only reinforce culture, but might also generate new ideas, right? And so I think the work from home, remote for at least part of the week or part of, whatever, however you want to think about it, is here to stay. And firms will have to think about how to accommodate that and make sure that it we fill in kind of the downsides to it, because there are downsides to it.
Greg?
Yeah, basically the same thing. I think we're starting those discussions now, and it's how do we accommodate the new flexibility. My team is global. We've got about 35 people globally, and nobody had any work from home time. Nobody even had a day a week or a day a month. There was 0 people doing it, and now everybody's doing it for the last 3 months. So we got to figure out how do we go back and keep the culture and the networks built up. So I think that's even when I get feedback from the team, that's what they miss the most, is to stop and by your desk on the way from lunch or to the coffee machine or at the water cooler, is those informal encounters and that sense of togetherness and unity, and we're in this together, is much tougher over Teams and over audio calls. So we have to find a way to balance this, the flexibility for the employee, for the team member, and to meet their needs for work life and home, but also that they're still connected to everybody.
Yeah, I think a lot of firms have been able to be successful in the short term because they're leveraging the goodwill that was created with a team that was working together in an office. The challenge is a new challenge, onboarding people remotely, and it lent itself well to an outsourcing business like ourselves, because that's one more headache that clients don't have to worry about. But maybe Warren, last to you, what are the material changes that you think will stick around?
Yeah, so I think that the new normal, and there definitely will be a new normal that's slightly different, is not going to be that dissimilar from the old one eventually, and that's probably hopefully sort of into next year, where there's going to be more flexibility, but it's all going to be around common sense. For example, if you've been traveling across the States or anywhere for 3 of 5 days and you get back late on a Thursday, there's no need to get into the office and kill yourself to get in the office just to be there for Friday. You can be just as efficient from home. So I think there's going to be a lot more flexibility in that regard. But at the end of the day, all of us are selling something, right? A service, a product, whatever it is. And those that win are those that typically pitch up. And so people are going to get back on planes. People are going to go and commute to try and build new partnerships, establish relationships, and those are best done in person. However, I think a lot of those that were done for the sake of it in the past are now going to be done a lot more efficiently via a virtual means. So there's going to be that sort of segue. And what does that mean? I think the new normal is a far more efficient environment, but there's going to be a lot of the old normal that remains.
Wonderful. Well, thank you all for participating as an audience, and to our panelists. This has been a great conversation. For any of the audience who has any follow-up questions, please feel free to reach us at trustvista.com, whether for TrustVista or for any of the panelists, and we'll make sure we're responsive. Thank you, Greg, Pradeep, Warren, again. Everyone stay safe.
Thanks for putting it together, Abby.
Thanks a lot.
Take care.
Bye.
Cheers, everyone.
Bye.